Hey everyone, welcome. Let's talk about investing. Over the next few minutes, we're going to demystify the stock market. Seriously, we'll break it all down so it's super simple and easy to get, even if you're starting from absolute scratch. All right, so here's the game plan. We're going to kick things off by talking about why the stock market feels so scary to a lot of us. Then we'll cover the absolute basics, what stocks and bonds even are. After that, we'll get into how you really make money, and I'll show you a super smart and simple strategy. We'll even touch on paying less tax and wrap it all up with a clear action plan to get you going. Okay, first up, why does the stock market seem so, well, scary? Let's just acknowledge that big wall of fear right from the get-go. And you know what? If you feel intimidated, that's completely normal. Get this, a whopping 80% of people in France just don't want to invest. And the number one reason they give, it's that gut-wrenching fear of losing their hard-earned money. And yeah, that fear of loss is a huge one. But it's not just that, right? People think it's way too complicated, that it takes up too much time, or that you have to be some kind of financial genius staring at charts all day. We're going to bust all those myths right now. All right, so how do we get past all that fear? Well, it starts with understanding the absolute basics. And really, it all boils down to two fundamental building blocks, stocks and bonds. So what's a stock? Honestly, the best way to think about it is like a tiny slice of a pizza. When you buy a stock, you're buying a small piece of ownership in a company. So if you buy one share of Apple, congrats, you are officially a part owner of Apple. Okay, so a bond is totally different. With a bond, you're not an owner at all. Instead, you're the bank. You're lending your money to a company or even a government, and in return, they promise to pay you back with interest. So let's just make that super clear. Stock equals ownership. Bond equals a loan. That's the core difference, and understanding it is absolutely crucial because it changes everything when it comes to risk and how much money you can potentially make. Okay, that's what they are, but how do you really make money with this stuff? This is where we need to bust a few myths and get to the real heart of how wealth is actually built. You've probably heard people talk about dividends, right? These are just cash payments that companies give to their shareholders. But here's the thing, it's not magic money appearing out of thin air. When a company pays you a $1 dividend, the company's value and its stock price drops by that same $1. It's literally just moving money from the company's left pocket to your right pocket. The real engine of wealth creation comes from long-term growth and this almost magical force called compound interest. This is where your money starts making money, and then that money starts making its own money. It creates this incredible snowball effect that can grow your wealth exponentially over time. And don't just take my word for it. Look at the history. Since 1801, after you adjust for inflation, stocks have given an average return of almost 7% per year. Compare that to bonds at 3.5%. And look at cash in a savings account. It loses value. That's right, your money is actually losing purchasing power just sitting there. That's why investing is so critical. So, you're probably thinking, okay, I get it, stocks are good long-term, but do I have to become a Wall Street trader to do this? Absolutely not. There are basically two ways to go about it, and one is way, way simpler. On one hand, you have active investing. This is where you try to be a stock-picking genius, finding those hidden gems before anyone else. It's time-consuming and really difficult. On the other hand, you have passive investing. This is where you just aim to match the market by, well, buying a little bit of everything. It's low effort, it's cheap, and as you're about to see, it's shockingly effective. Check this out. Over a 20-year period, a mind-blowing 94% of professional fund managers, people whose entire job is to beat the market, failed to do it. Only 6% succeeded. That tells you everything you need to know. Trying to outsmart the entire market is, for almost everyone, a losing game. So if you're not going to try to be a stock-picking pro, what do? The answer is something called an ETF, or an exchange-traded fund. This is the ultimate tool for passive investing. Just think of it as a pre-made basket that holds hundreds or even thousands of different stocks. With one click, you can buy a tiny piece of the entire market. It's diversification made incredibly simple. Okay, let's talk about something everyone loves, paying less tax. When your investments make money, the government wants a piece of that pie. But there are some incredible cheat codes you can use to legally shelter your investments from taxes. So in Canada, like in many places, we have a progressive tax system. The more you earn, the higher your tax rate on that extra income. And yeah, your investment gains can get added right on top of that. But this is where those cheat codes come in. In Canada, we have these amazing accounts. There's the TFSA, where all your growth and withdrawals are 100% tax-free. Then there's the RRSP, which gives you a tax deduction right now, and even a new one for buying a first home. Now, the names might be different where you live, but the key takeaway is universal. Find these special tax-advantaged accounts. They are a game changer for keeping more of your returns.
Okay, we have covered a ton of ground. We've talked about fears, stocks, bonds, compounding, ETFs, taxes. So what do you actually do now? Let's boil it all down into a super simple 5-step action plan.
All right, here it is. Step 1, and this is non-negotiable. Build a small emergency fund first. Get 3 to 6 months of your expenses saved up. Step 2, choose the right tax-advantaged account for your goals. Step 3, open an account with a low-cost online broker. It's super easy these days. Step 4, buy a single, diversified, low-cost ETF that tracks the global market. Don't overthink it. And finally, step 5, and this is probably the hardest part, automate it. Set up automatic contributions every single month, and then don't touch it. Just let it do its thing. So I'm going to leave you with this one final thought. There's a famous saying, the best time to plant a tree was 20 years ago. The second best time is now. It's the exact same with investing. Don't wait for the perfect time to start, because guess what? It doesn't exist. The real magic, the power of compounding, works best over long periods. So the best time to get started is right now.